Welcome to the Dividend Talk podcast, episode 269, our monthly dividends update along with some earnings. Hey, European DJ, we've got another big show today. A lot of stuff coming up.
Never a dull moment in the dividend world. So if anyone tells you that dividend investing is boring, forget it, forget it. I mean, we're talking about a lot of stuff today. So, we will talk about some news of the week. And I think it's very clear that Kimberly-Clark and Kenvue has to be discussed a little bit. But then we had earnings. And for the one that I want to highlight here is, of course, Novo Nordisk. There's so much going on there also with the aggressive, let's say, bid on Metsera, bypassing, or as I said, outpacing Pfizer. So we'll talk a little bit about that as well. We have two other earnings. We also look back at the show from 2022, where we all selected a few stocks so that in total we will get a monthly dividend. So it's very interesting to look back after 3 years how
Yep.
that went. But we have also questions about, for instance, how do we deal with reserving money for tax? Yeah, when tax season comes, when it comes to dividend tax. Again, a question around the U.S. estate tax. It keep coming back a little bit because I think many people have it in their minds right now. But also, like, how do some of us live in a country where just the tax burden increases. How do you deal with your wealth? So you can already hear from that, and there's much more. A few stock related questions, also about fair valuation. It is a crazy show again with a lot of interesting stuff in there. So people, if you're listening already, and as you listen to us here, just be ready for another hour of pure dividend talk. I think the only show that really always talks about
Yes,
dividends.
it'll be fun and entertaining as always. But on that note, let's get the legal stuff out of the way. We are not financial advisors, so everything you hear is just our own opinions and for our entertainment mainly. So let's get straight into the news of the week. And we had Kimberly-Clark, you mentioned it there, Kimberly-Clark, and they have the acquisition of Kenvue. So we got a couple of questions on this. What are your thoughts on this? Is it a good deal? And how do you guys view these types of stocks?
I don't understand it. I really can't understand it, because Kimberly Clark was kind of not growing, yeah, very poorly, and then almost 50 billion for Kenvue. I mean, Kenvue is almost like the prostitute of the consumer staples, right? It gets spun off. Now Kimberly Clark wants it after 2 years being independent, and I don't get this one. I mean, I understand that Kimberly Clark feels that they need to do something. I must confess I've not analyzed what the fair price is to pay for Kenvue because it's totally not in my world of interest here. But yeah, it's a bit weird. It's a bit weird for me. A bit quick.
Yeah, I mean, Kenvue are trading at a PE ratio of around 22 or 23, which is quite elevated for a company
Yeah.
of that caliber. But they do have some really strong brands. I mean, Band-Aid, Listerine, there's another one, Tenlon or something. But it's really strong
Yeah.
brands. So I can see why Kimberly Clark would actually buy this type of company. I think it complements their brands quite well. And if their goal is to make this global health and wellness leader, it's probably not a bad acquisition from them. Now, again, I don't know the fair price. I haven't looked at it from that type of view. But you're looking at a company there that owns Kleenex, Huggies, Band Aid, Listerine.
Yeah.
So it's quite a strong portfolio, you would say. And Kenvue looked to be on paper at least. Well, I say on paper, I haven't looked at the financials, but if I'm looking at their PE ratio, it looks like they're growing much faster than Kimberly Clark was. So maybe they're trying to take advantage of a little bit more higher growth to complement their kind of slow growing portfolio. So
Yeah.
I honestly do think it makes sense. We were asked how it compares to like the European tissue company, I think tissue and hygiene company, which is Essity AB. I mean, I
Hmm.
don't know them. The only thing I know is that they are pure play, just tissue and hygiene, which is probably a little bit
Yeah.
different than what Kimberly Clark is now.
But
So,
we talk about strong
Yeah,
brands, yeah, but there are many companies with
of
strong
course.
brands. Think about Reckitt Benckiser, think about Unilever. Yet many of them struggle with growth. Yeah. So if I look here just at Kenvue's revenue, it made 15 billion revenue over the last 12 months. It was making the same in over 2022. Yeah, when you look at the earnings, it's all the time around between 1.5 to 2 billion. It is really, there's nothing that shows a chart that's going upwards and to the right. Yeah, it's rather flat with everything and even a little bit fluctuating. So I just don't see, to your point, if yeah, and I see it now, it's 22 PE. I don't
Yeah.
see it.
I mean
I don't
being
see it.
flat over the last couple of years is probably not a bad thing considering the environment we're in. High interest rates, inflation was also high, I remember. So the consumer was cutting back on some of these brands. So to even stay a little bit flat is probably not so much a bad thing from Kenvue. So
Yeah, no, but not then it needs to trade at a 12
yeah,
PE
PE like
if that's your
for me, the
argument.
PE ratio, as I said, was too high. 22 was too high for this type of company.
Yeah.
But
So what you then depend on is on synergies, that they start cutting all the duplicate stuff that they have in the companies. But if I look at the cost of sales, that's for 6.2 billion there. And then we have selling, general, and administrative expenses, another 6 billion only for Kenvue. So maybe they look in that area that they try to get a billion out or something like that. But still, it will not. Yeah, I
yeah,
don't see it.
yeah,
I don't see it. I think it will just load up Kimberly-Clark's balance sheet. That's what it will
yeah,
mostly do. And then in 5 to 10 years from now, we're talking about a
yeah.
potential dividend cut. Maybe it's
I
just
think we
it.
kind of answered the question around is this a good deal? We know they're already trading at a 22 PE. Presumably, they've paid a premium, not just 22. They may have paid 20. I don't know. I haven't
Yeah,
calculated. Maybe 25 PE. So you can guess from what we're saying that we don't think it's such a good deal. But I do understand why they would buy that company. I do think it complements their current brands. But as you said, just because it complements it doesn't mean it's going to grow like we expect. And the balance
yeah,
sheet is weaker
exactly.
for it. So let's see.
Yeah. So I mean, I stay away from both of them. I just don't really like them.
Simple as that. Dutch directness. We like it. That's what we're
Yeah.
here for.
No, no, but hey, it's a market of stocks. Everyone their own favorites in the
Yeah.
portfolio, right? I, we'll talk about it later, but you only need to be right for 40 to 60% in your portfolio to do the heavy lifting.
Yeah.
Yeah. So um,
I mean,
yeah,
that's why we diversify. But hey, more we might.
will be a nice topic for Malmö. We even haven't spoken about that. We had a few more signups this week. The WhatsApp group is already very much enjoying it. I saw that Carlsberg has already been has it ordered because a train passed by with full with Carlsberg stuff. So we have our witnesses already in proximity there. But I'm afraid that this will become a real pub talk. I can tell you already. This will be like, I wonder who will be still walking straight on the way home.
Well, I'm looking forward to Carlsberg, real Carlsberg. I have to say, when I fly into Copenhagen, the Carlsberg is always so much nicer there than over here. So let's bring it on. Bring it on. Bring. Hey, they might need another truck. We get another truck. Let's move away
Exactly.
from alcohol before I get too excited and talk about dividend hikes. Snap on, which you looked at recently, a company that I believe you like.
Yeah, the deep
Yeah,
dive about them. Yeah.
14% dividend hike. What do you think of that?
Well, I mean, it is just this. We say it every time when we talk about Snap on. We should have listened to our listeners back then and just buy it. I think it's amazing. A double digit hike under these circumstances because they are having some industrial market pressure, let's say, and I'm just impressed with it. I'm really impressed with it.
Yeah,
So for me, look, I would like it still a little bit at a higher yield, but at a certain moment, I will have to pay up for quality, and Snap-on is definitely that. But what I also saw in my analysis, if a real recession happens, this stock can fall 50 to 60
yes.
percent. So I think if you have patience, I think there will be better
Yeah,
times.
I think this, for me personally, it will be one to be patient on, knowing that historically through any recession, I mean, it's a premium brand, so people are
Yeah,
going to kind of shift away from premium brands during that moment. So it makes sense. Beck Beckton Dickinson, ticker symbol BDX, hiked their dividend by 1%, only 1%, which is not really a,
token
yeah, yeah,
appreciation.
exactly. And then Simon Property Group hikes its dividend by 2.3%. That's the second hike this year, by the way.
Yeah. Yeah, and I was actually today I was looking at Klépierre, the real estate French real estate company, and I think Simon Property Group also owns 25% of them or something like that, large stake. So it's always nice to see how these companies are invested with each
Yeah.
other, right? Who was invested with L'Oreal again?
It's
Nestle?
Nestle. Yes, Nestle.
Yeah, exactly. So there are many of such
Yeah.
deals, right? I think also Sanofi has an investment from one of those French companies.
Sanofi do. I can't remember who it is, but they definitely do.
Yeah, that's funny to see that, right? If you read all those reports here, so actually Simon Property Group gets also from the dividends of Klépierre.
They're
Really
dividend growth
interesting.
investors, just like us.
Yeah, I think so. I think so. So it's not just purely an American company. That's
Yeah.
all I want to say.
Nice. Okay, we have some earnings. We have three earnings to kind of look at. So the first one, everybody is asking about Novo Nordisk. We got a heap of questions on this. Luis asked us,
Yeah,
"What are your thoughts on Pfizer, war with Novo, on Mestra, and the possible growth with a great dividend?" We got a question from 8BR Schneider. I love that name. Do you think Novo's Nordisk forced deal with the US government to sell their weight loss drugs at a discount will hurt their
yeah.
margins? And then we got one from Johnny asking, do we think their dividend is safe? Which is the most important question for us because we build our portfolios on safe dividends. So I'm curious to hear your thoughts
Sure.
on how their earnings went.
Well, interestingly, why doesn't Kimberly-Clark buy Novo Nordisk? They buy now Kenvue for a 22 PE, and they can get Novo Nordisk for 13 or 14 PE.
Yeah, yeah, different.
Yeah, you get what
I
I
get what you
mean?
mean in terms of companies, but maybe it doesn't
Yeah.
synergies. It won't fit very well with our products.
Yeah, yeah, yeah. Maybe, but maybe obese people need also sometimes a tissue or a diaper or toilet paper. Yeah. So you can see a fit there. I think so. Yeah. But jokes aside, why I'm saying this, right? This PE ratio now, I think we need to also think here about value at a certain moment in time, because let's not forget this company is growing. Yeah, I want to start with that. Yeah, so sales increased 12% compared to last year.
Yep.
Yeah, 15% I said if you don't take the currencies fluctuations into account. They also increased their operating profit, but not that much as they wanted to, because they really spend a lot on their transformation internally. They I think they make one of the quickest transformations ever in a company. Also with letting go a lot of people, so there was quite some impact there. Sales in the US increased by 12%. Yeah, we do know that it starts plateauing now because they are fighting the generics, or I say the non-branded ones. um, but yet this is growing. And we also need to know there are 900 million obese people in the world. Only 1% is kind of expected to be treated with some of their drugs at the moment. Yeah. Um, so I just want to give that if you look to the report, everything is growing. Yeah. Also, their is it their the diabetes and obesity care business is growing by 12%. And specifically the drugs and obesity 37%. Then also they expect their outlook sales growth to be 8 to 11%. Yeah, but this is a little bit disappointing, I think, because it was 8 to 14% not too long ago here. So they keep on
Yeah.
adjusting, and what we see is that the growth has been very much decelerating a lot. But I just want to come back to this thing, like, it's growing. How many stocks do we see that are flat or struggling with growth, both top line and bottom line, and they're yet still growing, still valued at 2025 PE? I think this is really important to keep in mind, because there's this question, right? We had a few questions from our listeners here, and one of them is the dividend safe? Yeah. Also because of the acquisitions. Now, we are not giving advice here as such, but I, if you just, it has a relatively strong balance sheet. The company is growing. They're also acquiring potential growth. Yeah, because if we look at Metsera, there's also one of the questions that we got. And then the question is like, okay, so they are going to pay about 7.2 billion for this. That's their deal. Yeah, and try to outbid Pfizer here. You need to know that they are really also focused on obesity, and they seem to have a top drug in the pipeline there, both oral and injectable. And it seems to be quite unique and potentially best in class. Yeah, both in efficacy and safety. So, and this is very important for them. So what they are effectively trying to do is get the best of the best in class drug that is in the overall industry pipeline. That's what they're paying up for. I believe that it's probably worth it if that becomes a blockbuster. Yeah, because we're now having this race of patients don't want side effects.
Yeah.
Yeah, what they are having now, like throwing up, these kinds of things. Yeah, we're still dealing with the first generations of these GLP-1s. So what I'm trying to say is, like, the company is growing. It has a reasonable balance sheet, so I don't really see any issue there from that point of view. Um, I mean, they have 89 billion in long-term debt and 170 billion in total equity. So we're talking about a 50% debt to equity. That's healthy. Yeah, we always say not more than
Yeah.
60 percent. So when you think about that and you look at Novo Nordisk, yeah, it is bad, yeah, because they screwed up and they are still licking their wounds, yeah, because they screwed up by not having manufacturing capacity on time, so that all these copycats were able to start selling there. But then you can get Eli Lilly for a 40 PE, which is of course doing everything right at the moment, growing really nicely, growing faster than Novo Nordisk. But I find the valuation gap in terms of multiples very, very, very big. And but I do also believe that Novo Nordisk needs to be punished for poor management over the last year. I know that the new CEO is trying to do a lot to fight this and to turn it around. But I would always say, like, yeah, you can maybe trust the guy, but stay skeptical. We want to judge the CEO by their actions, not by their words. So yeah, there's one more thing about Novo Nordisk. Also, they did a deal with the U.S. government to sell their weight loss drug. What is nice here is that it, I believe, becomes part of the Medicare and Medicaid, which makes it much more accessible to many more people at a more affordable price. So they expect this to have impact on their growth. So it's not saying now it will not grow. You really need to read what they are saying, but they expect less growth because of this growth, because they are giving a discount to this. But I think it's wise. You want it as much available as possible everywhere. You want to build. You want to continue building the brand around Ozempic and Wegovy. I think that's important. So it had to come with such a drug that is so important to society. It had to come there. Also with how US politics is going, and yeah, so I'm fully with supporting Novo Nordisk to do this, to get it into the package. It makes it more accessible, easier accessible, and we're still talking only about the
Yeah.
US here. Yeah, still a lot of the rest of the world is untapped at the moment. So um, I mean, I have the company, full disclosure. I own Novo Nordisk, not selling it, not buying it more. I want to stay to my rules of what I need in my portfolio. Um, but yeah, I would say, like, guys, just read up a little bit on it, and stay to the facts, not to the noise. Stay, don't look too much at the share price. Do your own analysis. Have a look at the balance sheet. Have a look at the growth projections. Look at then at the valuation and judge yourself. The main question you need to ask is like, can the company continue to grow over the next 5 to 10 years in this crowded market soon? I believe so, yes. But you really need to know, look at the epidemiology of this growth potential. But it will be a tough market, lots of competition. But I still think that Novo Nordisk is well positioned for this with their brands. I mean, many people speak about
Yeah,
Ozempic.
yeah,
Yeah,
of course. Like when you hear weight loss drug, Ozempic is the first one that will be on people's lips mainly.
it's a little bit like I want a
Yeah,
cola, yeah, a Coca Cola,
yeah.
yeah,
So we'll try and touch on all the questions to make sure we've covered it all. Because I find it fascinating with Novo Nordisk because I think they're basically dropping the share price because they keep dropping their guidance, so they got that completely wrong. Mainly because Eli Lilly's probably taking some market share, and mainly because they may have overestimated what the growth rate was actually going to be.
but they're just screwing up
Yeah,
themselves with everything.
so it's bad management. But as Lewis asked, what are your thoughts on Pfizer then in this space?
Well, I just mentioned to it. I just mentioned about this drug, right, and the deal that they want to do. So we'll see. Pfizer has the right to negotiate a deal again, but they will have to pay more for it, and then Novo Nordisk has nothing to do. So it's written in the small fine print in the news release
Yeah,
there.
but I mean, we speak about bad management, and I feel that Pfizer were sitting on an absolute gold mine during COVID, and I don't think they did enough during that time. So to me, they're still kind of like a turnaround play. That you might get a decent yield from them, but they're still a
Yeah.
turnaround, and they're so early in this space. I don't know. It's hard for me to take them that seriously in this space, if I'm honest.
No, no, that's true. And Pfizer, I mean, Pfizer wants to just buy themselves into this market as well. That's what they're
Of
trying to
course.
do. But if you then look at the company, I find it a very tricky one. Pfizer again, debt. There will be. It's not that much debt from that point of view. Looking at how big Pfizer is, but yeah, I don't trust Pfizer's management at all. I think many people are just simply in it for the high yield.
You touched on the answer to this already, talking about Novo Nordisk have a market outside of the US, but do you think that the forced deal with the US government will impact their margins long term?
Yeah, of
Yeah,
course.
but
Yeah, but I think that's what people just need to get adjusted to. Is also in Europe they want to get it eventually all in the packages so that it gets reimbursed, right? So
yeah,
yeah, it will, and the same applies to Eli
yeah, but
Lilly.
I don't know by how much it. I think the commercial insurers would have a bigger role to play if they were to follow suit with Medicare and sell at a cheaper price.
Yeah, but what you need to think about, obese people are such a cost to society. Yeah, it's not just that they are thick and need to get slim for looking nice, but think about heart attacks, all this kinds of stuff. It is there's a lot of health risk related to obesity. So I think the business case is really clear. If you can, for a few thousand euro, get people to lose weight and improve their health with that, I think it pays off from all the other stuff that can come their way. Cancer, heart problems, all of this, and because that's a burden to the hospitals, burden to society if they get jobless. So I think there's just a very strong business case to prevent people getting into this state, to have a healthier society. And I think these are just miracle drugs to support here. That's how I look at it. So I think for every country there's an incentive, I think, to do this, but they need to do it also with general lifestyle changes, and I don't know how that works in
Yeah, yeah, it's
practice.
quite difficult. And then the last question Johnny asked was, "Do we think the dividend is safe, considering the big outflows they have, acquisitions?"
Yeah, I touched also
Yeah,
on that already, Derek. I mean, I see no reason why it wouldn't be safe. The company is growing, both top line and bottom line. So
yeah, and debt to equity, as you said, what 50%?
Yeah. Those are the things that you need to look at, right? So, without going in detail, I think look at those. Look at it yourself a little bit as well. Open the balance sheet. Look at the debt to equity. Look at the payout ratio. Look at whether the company is growing. Look at their dividend policy. Look at the dividend history, and I think you'll quickly come to the conclusion that um, it is. It will be a different story if sales and net income were declining.
Yeah. Yeah, no, I 100%. I think I touched on that last week when we're looking at companies. There's a difference when a company is in decline because of stuff out of their control. Maybe there's the market sentiment or something, but their fundamentals are still growing. And I think Novo Nordisk fall into that category at the moment. So it
Yeah.
always works under you can't borrow conviction. And if you buy them based on share price when they were on a
Yeah.
roller coaster because they were forced into that market, you're probably in a
Yeah.
bad place. But if you bought them because of their fundamentals, you're probably sitting there wanting to buy more, and it's probably as simple as that.
And you don't own
No,
them,
I,
right?
I,
Because
I
I do.
don't own them, but I do have a put option on them. I do have a put
Okay.
option on them
Yeah, I
at
get it.
$40. I think it is to check. So,
Yeah.
which I'll be
Okay.
more than happy to exercise if that came in. So,
Yeah. No, so I'm at the moment on this position. I'm like 30% in the minus, but it's a small position still
yeah.
relatively. So
Nice, nice. I'll talk briefly about Wolters Kluwer. They did a trading update, so it's not going to be hugely in depth. But again, I mean, it's quite funny. We sit here on a high horse and say, don't look at the share price, ignore the share price. But then we talk about Wolters Kluwer because your share price has dropped below the €100 mark, which was quite funny because I believe on our Discord somebody said they bought them. They dropped the next day, and then you wrote back and said, "Can you buy some more, please?" So
yeah.
I thought that was quite funny. But I mean, again, I was looking through the report, and I mean, you don't get the benefit of getting like the financial statements in the trading update. But looking at what they've wrote, again, I don't see any cause for concern. I actually don't see why the share price dropped as much as it did. So the guidance is reaffirmed. So they didn't drop their guidance or anything like that. So we can't blame it on guidance like we do for a lot of other companies. They're still growing. So over the 9 month period, they're up 7% in constant currencies, 6% organically, which is quite okay for a company like Wolters Kluwer. Operating profit was up 15%, and free cash flow was up 17%. Again, in constant currencies, we're ignoring FX. Um, the CEO was quite happy. Said for the first 9 months, we delivered 6% organic growth as momentum picked up in the third quarter for health, tax, and accounting, just as they kind of predicted. So he's happy to reaffirm his full year guidance. So again, everything is going as planned there. 6-7% growth is probably what you're seeing across all the sectors. What they did do is that they finished their share buyback program 2 months early. So they had, I think, was it up to 1 billion over 2025. They finished that in November. So now they're adding an additional 200 million to that. So I mean, they're seeing
Yeah.
opportunity there. Um,
And that's only the if I would like to give a critical note on
go for it.
Wolters Kluwer, they've been buying back a lot of shares at those high
Yeah,
prices of 30 to 40 PE. I never really enjoyed that. Yeah, I really don't. And now could have been the time to slowly start turning on the
yeah.
buyback machine. It what have we, shareholders benefited from all the buybacks there
Nothing. No, well,
at the high prices?
at that price, nothing. At that price, nothing. Like, and again, they've the one criticism on that is they've also added 1 billion in debt over the past year, and they say that's allocated
Exactly.
dividends, share repurchases, and acquisitions. So they've added to their debt, albeit they do have a pretty strong balance sheet. So I mean, it's not impacting them massively. But again, I don't like to see that. I'd rather them not do the share buybacks. Don't add the debt and wait till they're at a much lower multiple to do that.
Exactly, and that's a pity. So this the only bad remark that I really have about the company. And other than that, we need to also address the elephant in the room:
Yeah.
AI. How do you look at Wolters
Yeah, I
Kluwer and
mean, it's
AI?
it's it's similar. It's similar to Essential, I think, isn't it? Because it it's going to go one of two ways. They're either going to use it to their advantage, or it's going to work against them. And
Yeah.
I think, I mean, I don't, I know AI is going to be a huge part in life, but it's not going
Hmm.
to eradicate everything. It just can't, because if it
Yeah.
does, the way I see it, if AI takes over every job, like what people are saying, nobody's working. If
Yeah.
nobody's working, then they don't need products. They don't need products. We don't need AI to make things faster or more efficient to make these products. It's kind of like
Yeah.
a flywheel that we don't want to get. So I think there'll be a balance there, and I think it's overestimated at the moment how much impact it's
Yeah.
going to have. But I think they'll be safe. I think they'll use it to their advantage. If I'm honest, the only thing I'm thinking with Wolters Kluwer is that they were trading at such a high price that
Yeah.
like not low, mid single digit growth, like 6-7%, is not enough to justify a 30-40 PE. So I think it's more
No,
of a reversion to the mean for them, and coming into a multiple that's more in line with their growth.
I think so. I think so as well. And yeah, again, I was still looking at the average shares outstanding. It did reduce it from 292 million to 238 million over the last 10 years. But it could have been just much more now that it's trading at these prices, right? And I think I wish for every company to think like Buffett. Be clear to your shareholders what you think is a fair value for the company, and just say, like, once the price goes below it, we buy back. If not, we'll put the cash on the balance
Yeah,
sheet. Yeah, and we take 5% or 6% in how is it in the interest rate on the bonds or something like that. Because what if you buy now back shares at the yield of 2.2% or something like that, then that's the only stuff where you really save on. Yeah. So I don't like it. Anyway, it's a wonderful company in my opinion. AI, I'm not so worried about it at this moment in time, but it's the main risk I think going into the future. I think that it won't be easy for Gen AI to be reliable. In the end, what people need to remember is that Wolters Kluwer is so ingrained in key core processes, whether it's legal, healthcare. There are probably quite some high switching costs. Yeah. On the other end, I think I mentioned in one of the former episodes, they're expensive as well. So if there comes how say it, a VC funded startup that like Netflix at the time, that gives you for $10 a whole library of information, while locally you pay $30 for old cable. Though that's for me really those will be the
yeah.
challenges in the next few
What
few
what I
years.
what I can say from my own experience in like in my role in automation, obviously we have to look at AI, and I've been lucky enough to be part of projects that have tried to bring that in on board.
Yeah,
It hasn't been cheap, not by a long shot, and the payback
yeah,
that we're seeing back versus the expected payback
yeah,
is not as good as it sold it in the beginning, I would say.
yeah.
So
I think so as well. Yeah, and I've got
yeah,
similar
so
experience.
I still think there's a long way to go. I like expect.
Yeah, but the question now that's below 100, how do you look at it? Because I think 100 is such a psychological barrier for many people.
What's their yield trading at there? I mean, to me, the price doesn't matter. If it doesn't meet my minimum yield, I won't buy it.
Yeah, I think it's
2.4. Yeah,
2.4% or
I think
something
I'd
like that.
rather around three
I think
three
so.
percent more, before I buy it.
Yeah, yeah. So you'll be still waiting a
Yeah,
little bit.
I'm like that meme that I'm waiting by the swings, just on my own, kicking it.
Yes, yes, yes. Yeah, yeah. I need to really. I've got a weekend to think about it. I always regretted not buying the company earlier. There, I need to have another look, but I prefer it also at 2.75% yield. So I'm not talking now about whether it's fairly valued, right? That's a total different conversation. I'm talking now about whether the yield has enough magnitude to have some positive impact to my
Yeah,
portfolio.
yeah.
Yeah,
I mean, again, like if you look at it from that point of view, they're growing 6%. So we can only assume the dividend will grow maybe 3-4% off the back of that. Given a low
yeah,
dividend yield, it's not going to be enough for me. So
yeah. But they did have a 5-year dividend CAGR of
yeah, of course, yeah.
13%. Yeah, and 37 years of no dividend cuts, dividend growth effectively. So we're talking here about the typical qualifier of a low yield, high
Yeah.
growth.
Okay, Ahold Delhaize, one of our companies we speak about quite often. And what are your thoughts?
Yes, and it was very quiet on social media because that day I had no time to do anything. So I'm really happy that we get to address it in the podcast. Um, One of the highlight, well, I mean, these are the kind of boring companies. First of all, very predictable. Sometimes they surprise us, maybe with a sudden write-off, but generally very predictable. What was for me impressive is that they had a 6.1% increase in sales to 22.5 billion. That's quite a lot, I think. Yeah, we were just talking about Kenvue and such not doing anything. Ahold is growing, first of all. What I was also impressed with is that their online sales increased by 12.2%, which is a lot. Yeah, mostly in online grocery and bol.com, the Dutch competitor of Amazon. If you think about it, I believe that online sales is now about 10% or to 15% of entire sales. So the company is really starting to catch up on this one. And I must also share here a little bit, right? Why didn't this spin off bol.com yet? They wanted to do that a few years ago. Now Amazon is going to try to have same day delivery, I think, in the Netherlands, really start fierce competition. Like spin it off at these markets, at these crazy numbers in the market at the moment. Spin it off. Now you can collect cash for it, keep a little bit of a stake in it if you want. But why hold on to it? They wanted to spin it off 2 years ago. Yeah. And I think it would be good to spin it off. I think there's a lot of unlocked value there that's not being priced in now into the company. It's not necessarily that it's that profitable that it helps with the dividend. So just take it, give your shareholders a massive one-off dividend if you, for the money that you receive, or pay down debt, or buy back massively shares at the right price, but do something with it. That's how I look at Bol.com at the moment. Um, Look, they had an EPS per share of 67 cents per for this quarter. So, generally speaking, it's now at 194. So, I believe the dividend is already covered for the year. So, we're good there. Also, the outlook is the same. And they announced again a 1 billion share buyback. So, this 1 billion is becoming
Clockwork, like clockwork.
normal. Yeah, like clockwork. But it was nicer to buy one billion of shares back at a market cap of, let's say, 25 billion. Yeah, then we're talking about 4% reduction. Now it's at 32 billion, so we're talking about 3% share reduction. Yeah, so the cash flow over the years, the free cash flow, is not doing a lot. Yeah, it's all the time around the 2.2, 2.3 billion. Yeah, then they reserved half for dividends, let's say, and half for buybacks, something like that. Yeah, at a certain moment, the free cash flow needs to start growing a little bit more to allow also for more dividend growth and buybacks, because otherwise they will start to leverage up the
Yeah,
balance sheet
or
too
start the
much.
buybacks.
Yeah, or stop the
I mean,
buybacks. Yeah.
they're trading. What are they trading at now? 33, 34 euro, maybe.
Yeah, but still PE of
Yeah.
16. Yeah, so it's kind of
Yeah.
okay. It's not a 20 or 25.
Nice. Look, kind of one of those steady ones. I enjoyed buying them at 23. I remember all the way back when we were
Yeah.
buying them. So it's nice to see him progress over the years.
Yeah. So I own them, and I told you just that they had a loss on Novo Nordisk, but also just transparent. I've got 85% up on Ahold Delhaize again, which is a much larger position than me. So I'm sharing this a little bit, this data, to show people the power of diversification.
Yeah.
Yeah, and Novo Nordisk, you just need to have patience with. It's a little bit with people invested in PayPal now. PayPal is growing and everything, yet you don't see it back in the stock price. But we are dividend investors.
Yes. And
So that's the difference. And these should be opportunities. We should be happy. But of course, it makes people nervous because there's a lot of noise around, there's a lot of narrative around. Typically, when the beers are the loudest
yeah.
at the moment.
But if you didn't have the news or you didn't have social media and you just read financial statements and nothing else, would you
Yeah.
buy these companies? And that would be the question. Do you know what I mean?
Yeah. Yeah. Exactly.
Okay,
Exactly.
enough on earnings. That's three. That probably concludes out earnings season as it is, which was quite hectic this one. So the next one it'll be the yearly one. I always look forward to that, especially with the European dividend hikes announced that around that time of the year. But we had this episode way back in August 2022. I had to go back and listen to most of it because I had forgot half the companies that we said at the time. We probably rushed our descriptions as well, so I had to listen to it to find the companies. But we picked companies that would give us 1,000 a month in dividend
Mm-hmm.
income, and I think we had a budget on what we could spend. I don't know if it was 10,000 or something like that. So I picked four companies and you picked three. So
Yeah.
I'll go over my picks first and a little summary of the notes I took on why I picked them at the time. So the first one was Altria, ticker symbol MO. So the reasons I said back then is it had a high starting yield of 7.8%, a long dividend history, strong free cash flow, and it was range bound stock because it was good for options. And if you remember around that time, I was doing the wheel
Yeah.
strategy, so it was all part of that. So it was range bound at that time. Since then, it was not so much range bound. It actually went a good bit up in share price. I mean, after the last earnings, it's probably gone back down, but it was doing quite well in terms of share price. But I think that thesis still stands. It's still a high yield, still has a long dividend history. I mean, in 2022, the dividend was 376. Now it's 424. So you saw roughly 4.75% growth on top of a 7.8% yield. So it actually did quite well in that period. The second company was AbbVie, ticker symbol ABBV, had a 4.1% yield at that time. The reasons was it was obviously as Sky Ritzy and Rindvok were the new kids on the scene. We didn't know how they were going to perform. Obviously, we know now that they've been doing quite well, but we predicted that it was going to offset a little bit of the Humira decline. Obviously, they had strong free cash flow, and the pipeline was quite strong as well. So that was one of my picks. Again, the dividend grew 5.35% from 564 to 656. So hey, good growth so far. Johnson Johnson was my third pick. Again, I felt like I had a risky one in Altria, so I had to bring myself back down to earth. So blue chip quality, ultra reliable dividend growth. We must have said the word chart porn or porn chart about 15 times when speaking about them that day, which was funny when I was listening back. But yeah, basically bought them because they were just ultra reliable. And again, a 5% dividend growth rate over that period. And then the last one was Realty Income. And the only explanation I gave was because they paid dividends monthly. And what what else do you need? But that has the
Yeah.
lowest dividend growth rate over that time, and it was only 2.82% in that time, which was quite interesting. So I look, I think they were interesting picks. All did, I would say, relatively well, and at least what I predicted at that time. But if I was to pick now, I would probably change definitely change too. I would love to swap all three for someone like ASR or like a European insurer, but then that breaks my streak of having dividends every month. So if I was to stick in the sin stock world, I would pick Philip Morris over all three
Yeah.
in this moment in time,
Yeah.
or British American Tobacco, which I already own in my portfolio. And I would replace Realty Income with Agree Realty because I think it's a little bit faster growing.
Yeah.
And we see this with the growth rate of 2.82% in the dividend, and Agree Realty is a bit higher. So, but interesting, right? Looking back and seeing the picks
Yeah.
and how they've done. So,
Yeah. And I would say they're relatively well done, Derek. You had reliable income, no dividend cuts, AbbVie, a lot of share price appreciation at the same time
yeah.
as well. So I think you did better than I did because if we look at my picks, the monthly ones, I had Castellum, the Swedish real estate company, until they screwed up there. So at the time, I felt like 5% yield. They have quite good commercial property. Um, but the issue was at the time management. So I thought that management was doing quite well until They didn't. Yeah. Also, we know that at a certain moment in Sweden, there was really this interest rate increased very fastly, and many real estate companies got hit by it. But here, there was also an investment from one of those legendary Swedish
Yeah,
investors to start, and he just canceled the dividend. One of the first things that he did. So I think number wise, it was maybe not even needed at the time. It was just like I think a fight on management
yeah,
level there. So of course I will throw Castellum out because they cut the dividend. But the other one was for me
mm,
Shell, and I thought like we're now 1.5, 2 years after the big reset of the dividend. I saw the cash flows coming in, and I thought like, well, this is going to grow over the next 10 years, right? And it did, yeah. So it grew around 12.3%. So I would think that was quite a good pick, and probably helping balancing out my pick on
yeah,
Castellum. Yeah, which is, by the way, in reality, I owned Castellum. I sold it. I just don't remember anymore if I did it with a loss or break even there. But I do remember that I bought other stocks for it with a similar yield. So I didn't lose income. Yeah, that's also important to say. And I had Texas
yeah,
Instruments because I wanted to diversify a little bit into another area. I thought about chips here. I really look at this company that supplies chips for all the simple stuff everywhere in the world. Safe dividend growth profile, and that one had a 5.8% CAGR, around 6%, which my typical target is. Of course, from these two, I would keep Shell and Texas Instruments here. I don't remember in what months Castellum was doing paying it, but to get to a monthly dividend, I would need to have another quarterly dividend payer, and maybe I would look into pharma or insurance here. And yeah, I would need to do some research when, but maybe we can do another time an episode on this. Like again, like
yeah,
what would be our picks and such if we would make all the picks from
yeah,
scratch right now.
yeah. Well, it's quite.
Yeah. But it's funny to get reminded about Castellum because I didn't look at that one for
Yeah, and
years.
I forgot to cut the dividend because I was looking for the history on that, and the growth rate was negative. I was like, what? I had to go back and read, and I remembered. Oh yeah, they cut the dividend.
Exactly.
So
Exactly. This was really poor management. Poor management.
yeah,
That's it.
hostile takeover. Hey, you can't legislate for that, but I mean, strong growth in Shell, 12.3% and 6% in Texas Instruments, and you got to remember Texas Instruments is in this like cycle at the
Cycle.
moment,
Yeah.
and they're capex heavy, so their free cash flow is lower than what we expect. So I mean, 6% is quite strong from them over that period. If they were in the top of their cycle, that would also be double digits, in my opinion.
Yeah. Exactly. Exactly. But now I get to now because I own also Shell and Texas Instruments. But for me, the last 2 years have been a very nice time to buy into Texas Instruments and build my position.
Yeah,
Yeah. So now when the cycle ends, they can come back with double digit
yeah.
dividend growth again. And I hope I will be in a situation thinking 2, 3 years from now, damn, I wish I bought more.
I'm sure we will. We always do. Whenever we say this type of stuff, and then we never buy. We like I had it with Siemens. Man, I kick myself. Siemens under 100. I kick myself all the time. But yeah,
Yeah. But I must say I've got quite a sizable position, so I'm not too keen on buying a lot of Texas Instruments. Again, I could maybe still do one buy if I look at it, maybe two small, but that's it. I'm effectively having a full, almost full position. Let's say 70% of what I would like to spend on it. So,
yeah,
and the price was coming down again. It's I think trading at around $160 at the moment. So not too
not too
shabby, right?
shabby.
As friend Ryan would
Yes,
say.
yes. I love that saying. Okay, we'll move on to some listeners' questions. We've got a few to get
Yeah.
through. And J Rig Wealth Management, owner is Jason Roos. So, what has been your dividend tax burden plan? So, just to give a full picture, what they do is they take a percentage of all their dividends, and they put it into a high yield savings account. So it's this kind
Yeah.
of out of sight, out of mind attitude, and knowing in the
Yeah.
background that that dividend is going to accrue interest, and it's just
Yeah.
there to use for dividend tax. So, do you have a
Yeah.
strategy for this?
Well, usually around the tax season, I also get my bonus from work. So, and there's always some bonus. So usually I use that to pay the tax bill where needed. Um, but it's not that much because in Poland you need to pay 19% dividend tax, and if 15% is if you have European companies, you just need to pay the additional 4%. So it's usually manageable for my bonus. If I would be living off dividends, it would be probably different. And I would either save it up or I would withdraw from a bit of savings account and then fill that savings account up again. It's really effectively a timing question. And but surely I would have the money on a deposit or something
Yeah,
like that for 3-4 months just before the tax pay
yeah.
date comes.
For me, it's nearly pretty much taken at source at this stage, because we have this encashment tax. I think I spoke about
Yeah,
it. So we have a withholding tax, and then we have the encashment tax on
yeah,
top of it, and that pretty much nearly covers all the tax that I have to pay.
yeah,
And whatever's left is a small amount, and I just pay it from my
yeah,
salary or my savings. So I don't really have a
yeah,
strategy, and I hate paying tax, but it's one of these ones that actually makes my life easier, because I still have to file it,
yeah,
but the money's already taken, so I don't have to worry about it.
yeah.
La finesse. What is the best way to build a long term dividend portfolio in a country where taxation keeps getting heavier and heavier every year?
Yeah, move out the
Ah, it's,
country and find another
but
country.
like, it might be as simple as, if it's so tax inefficient to be a dividend investor in that country, surely there's
Yeah,
other vehicles or other investments.
investment
So I mean,
styles.
so I would talk to a tax advisor and see what the best option is, if tax efficiency is your goal, and if it's just uninvestable to be a dividend growing investor.
Yeah. What I would just say, right, before your wealth becomes too big, check what the exact tax of the country is. Yeah, I believe Poland has a 4 million zloty exit tax, and after that you need to pay, I think, 19% on your wealth. Yeah, so that's, let's say, approximately 900,000 euro, a million euro. So if you're a millionaire and you're a millionaire in Poland, you will need and you leave to another country, highly likely that you have to pay the exit tax. So I would definitely look at such things before your portfolio becomes too huge, that you make sure that you also understand the exit tax rules. And if that's really an issue for you, that you move away from and therefore become a tax resident in another country before you hit that threshold.
So,
Yeah, and I know some countries have an exit tax, others are considering it. I think the UK is implementing one, right, per next year. That's why all these billionaires are flying out.
okay, and I
So
don't think Ireland has one. I'm just trying to look it up quickly here, and when I
I'm sure someone is writing one now then.
yeah, well,
Sure that you stay on the
if the
island.
UK if the UK are going down that route, it's only a matter of time before we follow suit. But I don't think we have one at the moment. So
Yeah. But would you ever leave Ireland because of increasing taxes?
no, I mean, it's not just my decision, really.
No, okay, but still. What? Okay, so maybe philosophical question. At what point do you think, okay, I can't live in this country anymore from a tax point of view?
From a tax point of view,
Yeah.
I mean, I don't know. I honestly think I will be willing to pay tax, so as long as my family are here. I think, like, money is
Okay.
irrelevant at that.
So, okay, let's assume that you get a leader that thinks we need to pay 70% tax on income, 60% on wealth. Crazy numbers. What would you do? You've been building with this little nice friendly podcast now for 5 years. So you're nicely building wealth, and the moment you want to live off dividends, it's not anymore, I don't know, 20%, but they hike it to 60% because they feel like you are wealthy. You need to be solidaire to the others. So there you
Yeah.
go.
that'd be quite tough. It'd be a serious conversation with my wife saying we need to
Oh
get
yeah,
out of
and
it.
you're retired of dividends, and you need to start working again.
Yeah,
Yeah.
that can't happen. There's no way.
No, no, but
Yeah.
that's why I'm
No,
trying to
no, no. I no.
figure out like where's your.
I get what you're saying. I get what you're saying. It would be a difficult conversation to have because, like, mathematically, you know when it makes sense to move out of the country, and there'll be a threshold.
Yeah.
But I don't know if my family would move, and I'm not going to move to, I don't know, let's say Portugal or somewhere on my own. What's the point? What's the point in having all the money in the world and then nobody there to share it with? So I mean, there's two.
Well, you share it with the government.
Share with the government. Yes,
Yeah, that's what you
they.
effectively. No, but I think it's a very interesting thought exercise, and maybe you should have it once at home because usually when you go to such kind of tax rates, there's more going on in the
Yeah,
country than.
of course.
But it means like they are doing a wealth redistribution from the rich, the so-called rich, and usually what we're talking about is the upper middle class here, which is a large group because they are too poor to have proper legal support to set up, I don't know, something in the Virgin Islands. Yeah, but rich enough to have enough wealth to share it with the rest of your citizens. So, and I think it comes down to the Laffer curve. I don't know if you know this curve. Like once the government increases the tax too much, they actually get less income and such because you take incentives and motivation away and
Yeah,
everything.
but the Nordic companies are quite high, aren't they? In dividend, or not dividend, in tax in general. But they get a lot for that. They get like healthcare and all that. But I believe,
And you don't get healthcare.
have you, the healthcare in Ireland is it's a touchy subject.
Yeah, but you know the grass is green in Ireland. It's a nice country. I've been there. There's a lot is working. So
Yeah, I mean, look, there's a lot of nice things here, but healthcare is just not one
yeah,
of those things,
yeah,
unfortunately.
yeah. No, it's very interesting. I wonder myself sometimes, like at what time, at what point would it be worth leaving? I think Poland is still in a really good situation tax wise. So compared to the Netherlands where I lived, it's much
Yeah,
better. So I don't have that feeling now, but wasn't it in the 60s or 70s in the US where there was also such a very high income tax and everything where they did it? And I have so personally, right? I have very big issues with the increasing tax burden also on me and the narrative of we need to take it away from the wealthy people, the rich people, the millionaires, which I'm not. But then those rules would typically apply to me in the end. And I think like, you know, I'm a citizen that is trying to avoid lifestyle creep, working hard, saving every penny where I can, investing for the future, and then you get punished because of you having saved and invested everything. So it's not for me about not willing to share. I think I share a lot as a next net taxpayer. Yeah. So it's not about that. I think we need a healthy society. For that, we need to invest in healthcare. We need to invest in infrastructure so that we have companies that can actually do proper business. It's not a. It's really not about not willing to share, but it's more like at what moment in time are you going to say like, you know what, I'll just start to work less because there's so much tax burden on me that it doesn't really matter anymore. And then you will see that the productivity, and if many people like that, the productivity goes down in the country. So I think for me, if for instance, if I would live off dividends and I would go above 30%, that would be for me a very big consideration to do go to another geography with let's say 15% or 20%. But it's not just dividend because you also need to look at all the rest, right? Because there may be a wealth tax in the country on top of that. So I think about 30% would be for me a reason to seriously start considering it if I would be living on
yeah.
dividends.
That's probably another episode in itself. But
Yeah, but it's interesting, right? I'm curious what our listeners think. Like, I know we are a bit expanding on this question here, but I wonder, like, it's really like, yeah, psychology in the end, a little bit. And I'm now starting to really wonder, like, how would that look like in real? Imagine that in Poland, someone says to me, "Yep, we are going to do now 30% dividend tax. EDGI, I'm out." Is that really what it will be? So it's not just the dividend tax, of course, it's also income tax and everything. But I will be. I'm it's also sometimes a topic in my mind. But now there's an exit
Yeah.
tax, and at a certain moment, I will probably reach that in my life. Yeah, knowing that you need to pay 19%, so almost one fifth
Ooh,
to that. And then once you've done that, you die a year later, and you pay this 40% to the U.S. Estate tax as well. I mean, it's like everything is truth. So,
speaking of the US estate tax, it's actually the next question from Exile. I mean, this has been the talk of the town, hasn't it, lately? It's quite a big deal, I think. But given that we have these issues for non-US investors, what dividend ETF domiciled in the EU, probably Ireland, would you recommend for a dividend growth investor not willing to buy US stocks and assuming the investor buys individual stocks from Europe and other world regions?
yeah, I would probably go for the Van Eck Dividend Leaders ETF, TDIV. Um, I would probably go for that one because I see a lot of strength in that ETF. But the main watch out here is, of course, that it has quite some exposure to banking. So I think people should be aware of that. But I think TDIV is one of the
Yeah,
better ones. And I own it in a retirement account somewhere. And this year it did really well in terms of capital appreciation, but also the dividend continued to increase. So yeah, I will probably go for
yeah,
that one.
nice one.
How about you?
I can't remember, but we had a list. I didn't open them, but yeah, I remember Van Eck was top of the list on one of them. So we'll stick with that. ETFs are not my forte, so
Yeah.
we won't go there. Fabian has asked a nice question. So I see many people in the community spending a lot of time on fair value calculations and tuning their discounted cash flows and dividend discount models, but yet having a low confidence in their own estimations. Nevertheless, to save time, what he does himself is that he looks at the Morningstar fair value estimates. So, do you think it's a legitimate kind of thing to do to outsource this step of one's due diligence?
Um, so let's say like that. I think Morningstar, I like for their analyst reports to understand what they're talking about. I don't necessarily always agree with the fair valuations, but I think the answer is simple, Fabian. If you have conviction in that model and you find a solid model and you understand how they come to the valuation and therefore you feel that that's a good anchor to follow, go for it.
Yeah,
Yeah, it's really your conviction. You need to feel fine with it, and you will learn over time whether Morningstar is actually doing it right or not. I think, and then I also do DCFs and dividend discount model. I also look at the multiples. So I look from different angles to it, right? So people that read our deep dives typically see that we look at price to earnings, we look at the price to free cash flow, we look at the dividend discount model, we look at the discounted cash flow model, and sometimes we look apply the dividend yield theory. So those are five lenses that you can apply to a price. I think if all five come kind of in a range of 20% of each other, then I think there's a high likelihood that that kind of represents the fair value of the company. But I just want to say in the end, guys, it's more an art than anything else. The assumptions are key here. There's a lot of bias in assumptions. You may extrapolate the past to the future, not having done enough business analysis, and therefore you may not spot such things as well. So it's just very, very hard to value companies specifically if the price is not the share price of the next 6 months. 6 months is not agreeing
yeah,
with you. Yeah, so it's more art, but for me, I look at those 4 to 5 lenses, and that gives me a feeling for the value, and that's then what I look at. And sometimes, we write a deep dive or do a stock card, You may wonder, like, why did you spend your time on it? It's like 100% overvalued. Well, at least we know then when the price comes down, like Wolters Kluwer now, when it's time to have another look at
Yeah.
it again. Yeah, and I think Wolters Kluwer is a typical case here. So Fabian, if Morningstar for you works, I would say by all means go for it here. But just test your model after a year, whether it kind of worked for you
Yeah.
or not.
Look, I think it makes sense because, like, valuation, as you said, it's an art. It's not an easy thing, and everyone has their own opinions. Everyone will have their own conviction on what they see their growth rates and their estimates will be, and sometimes you might not even know what the estimates are yourself. You might be looking at an industry where, I mean, the last 10 years they did 10% growth, but you're not sure if they're going to do that in the next 10 years. So
Yeah,
you're kind of they're not making it up. You're trying to make educated guesses, but that's all they are. And, like, I understand it. It's something. It's not my strongest part either, and I always second guess. And I think the difference with me and you is I'm a lot more conservative in my growth rates a lot of the time because we chat backwards and forwards around some of those.
yeah,
So I completely understand. I completely understand why you would outsource that. But I think for me, why I persist with
yeah,
it is when I spend the time researching the company, I think I have a decent understanding of it, and
yeah,
over time you can adjust your model because you'll get to know the company more and more and more because you're going to read about
yeah,
it more. You'll know more about it, and you'll know quite soon. Like we go back to our monthly dividends that we picked. I picked Altria high dividend yield. I
yeah,
knew what I'm buying them for, but I also got 5% growth on top of that. So would you say they were
yeah,
fair valued at the time? I would say yes, but that's looking back. That's looking
yeah.
back.
For me, the dividend safety is much more
Yes.
important. Yeah, because and it's to some extent a little bit easier to look at because you really just need to look like, has the company grown? Is it still growing? And for that, you can kind of see what the trends are and what the expectations are. Often management reports already in this. You can look at the dividend policy. Is it is it like to grow dividends? Is it progressive or is it payout
Yeah.
ratio? Yeah, you can even look at the payout rate. You can look at the balance sheet, debt to equity. So if you are able to read the three financial statements and you have a feeling of whether the company will grow, even if it's like 1% in earnings, yeah, maybe you get them 1% in
Yeah.
dividend hike, but it's growing, the dividend is safe, and the price becomes less relevant at that moment in time. And that's why when you go more into income investing, you look more at the starting yields. So you and I have some criteria. I say it needs to be at least 2.75%. Otherwise, it makes no sense for me because it needs to then grow so fast that usually I don't buy such stocks in my portfolio because they are like already to the moon. And then the valuation is purely on the yield itself, but you just the downside of that potentially is yield traps. But that's why having an understanding of the dividend safety, so investing knowledge building in the three financial statements, I think with the strategy that we have for wealth building and investing is probably more
Yeah.
relevant here. And the fair value assessment is more like a
Yeah, yeah.
bonus, I would say.
Dividend safety is it's as simple as is everything growing except for debt. I mean that you don't want
Yeah,
that, but you want top line, bottom line, free cash flow. If all that is
yeah,
growing, you're meeting your minimum dividend yield. It has done your expected dividend growth in the past. It's likely to do it in the future. It's probably that simple, and you don't have to get too complicated with it. But who knows? I mean, we could be talking absolute rubbish here because, as you said, it's all estimations when it comes to valuation.
yeah. But this is our opinion, right? It's in our opinion, and we
Yeah.
may be wrong.
We got a question from Anzi, and he's been looking at car manufacturers lately, such as Volkswagen. Looks pretty cheap, historically low price, PE ratio of around 7, has a high dividend yield. Would this be a good time to buy?
Well, if you think from a valuation point, maybe, but it's an industry I would never invest in as a dividend growth investor. I mean, this feels like some an answer like you want to torture yourself over the next few years. Yeah, and I'm very worried about the German car industry with all the Chinese stuff that is coming, BYD and such. I don't know if you have it as well. When I see driving a BYD on the road, I have this very strong feeling of like, why is buying someone a Chinese car if you know that buying those kinds of products, you're kind of killing the industry in Europe. And I understand it. It's capitalism, but it's not like China is playing a fair game, right? In competition. So I get this. I get more and more this feeling why Americans are buying American products, because they have been dealing with this for decades already. But now I get this feeling in Europe also more like with Chinese products, like that I feel like, no, I go probably more for a European one. But of course, I don't want to step into an inferior
Yeah.
product either. That's why it's so kind of a mind fuck for me all the time.
I
Like
mean, I suppose the difference
that.
in Europe is like America collectively is one country with a load of states. Europe is loads of countries. So, at what state do you go? I'm not buying European. I'm
Yeah,
buying German. I'm buying Polish. I'm buying Irish. Do you go down to that level?
but Derek, if Germany sneezes, the rest of Europe is having a cold. It's as simple as
Yeah,
that.
we know that. Yeah, it's been sneezing for quite a while, but
Yeah. So we need a strong Germany. That's how I look at it. And car industry is very important in Germany. So I couldn't buy a BYD at this moment in time. I couldn't, because I know that this is like a lot of state funding behind it, unfair competition. But on the other hand, if you look at Volkswagen, I mean, what have they done? Yeah, I know there are now electric cars out there, and they are becoming more and more popular. But you know, I feel like BYD and Tesla are so far ahead that it will be hard for them to
yeah,
catch up.
I
Very,
think
very
so.
hard. So only sentiment like people like me that say I go for European first. But really, is that what your business model needs to depend on?
No,
Mm,
it's quite tough,
no.
quite tough.
Yeah. So I stay away from this entire industry. It's too cyclical. Dividend cuts are all along the way. From a valuation point, Anze, I cannot help you there because I've not looked into it. You might be right.
We got a question from Jeremy about our favorite stocks heading into 2026. I think we'll keep that for an episode in December.
Yeah, it's November. I haven't asked that question again. Once I've heard Mariah Carey on the radio.
Give me a second. I'll just put on YouTube here.
No, don't do that. Don't do that. Don't do that. No, I have not heard it yet. For me, that's always the first time when I hear that, I think like, shit. Do you have the same feeling?
I mean, like it's getting earlier and earlier every year. Like we went. Where did we go yesterday? I can't remember, to a shop and had already Christmas trees and lights up, and I'm like, it's Halloween is just over. I mean, it's the first week in November. Give it some
Yeah.
time, but yeah, I'm the same. As soon as I hear it, I'm like, oh, another month of listening to this. It's good. It's it's
Yeah,
it's great
exactly.
for the first like day or two, and then you just get sick of it. So bad humbugs.
Yeah, then it's in your mind and you love listening to
What's
it.
that?
Then it's in your mind and then you love
Yeah,
listening to it.
yeah.
Yeah.
We got a question from Fire Engineer. If you could invest in one NGO or charity, which one would you choose and why?
Kiva. I've been actually, and I still do that. I'm always cycling 50 euro into it. So Kiva is quite a nice NGO because there they do crowdfunding. For instance, I don't know, people in Kenya that are want to buy some cattle, and they're collecting $500-600, and you can chip in, and then they pay it back over the next 2 years without interest rates. I like that because when you're investing, at least I started to appreciate entrepreneurship much more. And this is a way where you're not just giving money and you never see it back and you hope it will ever reach someone. But this is, no, you're really investing in someone that's building a small business, or buying ingredients for soap to sell it on the market. And so far I've been always paid back. I'm doing this now for five
Oh,
years I
nice.
think, in Kiva. And I like that because it's really stimulating entrepreneurship and business, building
Yeah.
businesses.
I mean, I don't know if I'd want to invest in a charity, but we do donate quite regularly. And I know I spoke maybe 2 or 3 years ago. I set up a business with my niece selling bracelets. It's still going. She's still doing really well, relative to her age, 13. But as part of that, every Christmas, so this will be the third year, we take 20, well, it was her choice, but she takes 25% of our earnings, and she'll buy presents for kids in need or food and all this, and goes down. And it's quite a nice thing to do. But yeah, I think I like sticking with more local charities because one, you kind of know the people impacted, and two, 9 times out of 10, I know the money is going to go where they say it's going to go. And one that we try to go is with Down syndrome Ireland, or specifically Waterford and
Yeah,
Special Olympics and stuff, because I have a niece like that.
yeah,
So that's where my money goes.
yeah. And generally, I always like on LinkedIn, for instance, when some colleagues or former colleagues are, I don't know, going to climb the Alpe d'Huez or something like that. I always like to contribute a little bit there as well. And it's for a good goal. People are passionate about it, investing in it. So those kinds of things I always like to do. And of course, locally here, if something's at the church happening with a collection or something like that. But I'm always very keen on who, for who. No, not so much for who, but what is the money used
Yeah,
for?
yeah, exactly, exactly.
You know, I prefer to have no middleman, almost, that I can give it
Yeah,
directly.
exactly. I think uh, Special Olympics Ireland, they're bringing them all obviously to the Olympics, and it costs a lot of money. So we invest, not invest, we try and support that as much as we can. Agrivi has asked us our thoughts on General Mills, ticker symbol GIS, at the current valuation, and what do you think about the company in general? Um, I mean, I don't know the company too well, I would say. Other than they have a really good dividend track record. I think it was 127 years of uninterrupted dividends. So, I mean, it deserves respect from that perspective. I can see why it's interesting at the moment. It has a high dividend yield, it's 5.25%, trading at a 9 PE, and it has some well known brands such as Nature Valley. So, I don't know if you have Nature Valley bars, but we do, for example. So, I can understand why this is popping up. I can understand why it's on the question. I just don't know them well enough. But given their dividend track
Yeah,
history and that dividend yield, it might be worth looking at them. But maybe the dividend growth is going to be so low that you're just relying on that yield. So I
yeah.
don't know.
So General Mills is really interesting. I looked at it a few times. It's really, I think, canned food and everything like that. Yeah, what it's selling. Do you know that it's trading around COVID levels again? Like 2019, and then of course during COVID it did really really well in the aftermath of COVID, all the way to 2023 when it was trading for 85, $86. Now it's $46. Yeah, I always felt like it was too expensive at that time, but looking at it where it trades now, it is definitely worth having a look at it. Again, I would say, because the multiple is under
Yeah.
10, and I think that is not too bad. But I don't know, right? I've not looked at the income statement if there are some special items or so. But this is like one of the most boring companies that you can own. The question is this company being impacted by the health conscious consumer? I mean, I believe they sell a lot of canned meat and everything, but I can't remember when I bought that the last time. I think it was probably 30 years ago when my grandparents opened up such a can.
Yeah.
Yeah. So, and I don't understand the American culture enough to say something really good about, but I think it's worth to look into
Yeah. I
it
think, no,
a
I
bit
think that
again.
PE ratio and dividend yield alone is enough, but it also makes me think what is wrong. Like a company like General Mills, you
Yeah.
don't expect a yield of that
I
high.
know they did an acquisition not too long ago, but I forgot what it was about. So it's also important to look at. But they have like a 2 billion free cash flow at the moment of the last 12 months, and their dividend payment is 1.3 billion. So we're talking about 65% payout ratio. On top of that, they've been buying back 1.4 billion in shares so far over the last 12 months. So I guess they are reducing the shares a bit faster now than they did when it was at 85 dollars. So it may be just one of these that, like, if you use the dividend yield theory, that could be interesting. But again, yeah,
Yeah.
interesting one. Thanks for bringing it to my attention, because I have to
Yeah.
look at it.
Yeti has asked, do you look at utilities in the US at all? They're a bit hard
No,
to understand because they're constantly in negative free cash flow.
no. If there's one thing about utilities in the US, And what I've always observed is they feel so poorly maintained. Do you have the same feeling about US utilities?
I struggle more with US utilities than European.
Yeah. Yeah. I have the
And
same.
I don't know if it's a culture thing or what it is, but it just doesn't feel the same. And I mean, yeah, they just I find them a little bit harder.
Yeah.
Um,
Yeah.
Kevin has asked about exposure to US oil. So next to his positions in Shell and Total Energies, he's wondering if you had a choice now, would you choose ExxonMobil or Chevron?
I think still ExxonMobil.
Oh,
Yeah. I've, I like Chevron generally a little bit more in sense of investments in capex and capital projects, also management. But I think ExxonMobil, they have one of the best reserve lives in the world. Very strong balance sheet, less
yeah,
yield, but I will probably go for the safe. Yeah, ExxonMobil shows more
okay.
safety. Let's
Cool.
say it like that.
New to this has asked a question about Greencoat Wind. And we got asked a question about that a couple of weeks ago, and we said we would look into them for their earnings. I could not find their earnings last week, so we didn't do it. But the question came up again, so I thought we would take it at least. Um, he owns the sister company, but the performance has been pretty poor for these companies over the last couple of years, mainly in terms of share price. It's down. I think it's one of my worst performing in terms of share price. Um, in my portfolio. So what are your thoughts on Greencoat? Are you still bullish on them? For him, he can't understand the underperformance because he believes in renewables, but just interested in our point of view. And look, I think it's a really valid and interesting question considering how they are performing in terms of share price. Um, I think there's obviously a few reasons for that. Interest rates really hurt these types of companies, and they've been pretty high over the last few years. So that hasn't helped. Also, we've seen like softer wholesale electricity prices. So that has had a massive impact. I mean, during the energy crisis, we were seeing huge pricing, like huge spikes in prices, and that really helped them. But that has softened, and actually, it's been lower than expected over the last 2 or 3 years. So high interest rates, lower revenue from electricity is going to hurt our growth. There was also talks in the UK to move from a retail price index to a CPI, consumer price index. And basically, this kind of calculates differently how they are like their inflation number. So we know that their dividend is linked to the inflation, the RPI index. So if inflation grows, I don't know, maybe 4 or 5%, the RPI, their dividend is expected to grow with that. Generally, the retail price index will be a little bit higher than the consumer price index. So what does this mean for us? We will expect lower dividend growth. And also when this kicks in, which I think is around 2030, there might be a rebasing. So technically, we could see a dividend cut around that time. I'm only speculating, but it's a potential. So it's definitely something to look at. And again, their revenue then they have these ROCs, which is renewable obligation certificates. They are also linked to inflation. So the revenues that they get from that, if it's now being calculated off CPI, will be a little bit lower from 2030 onwards. So look, I think there's a lot of negative things in the market at the moment. I am a big believer in renewables, I have to say. Um, but I mean, you have to be kind of realistic here and see there is issues with green code in terms of dividend safety. You have to kind of look at that and see the potential around that and how do they adjust that? Did they stick to RPI growth, for example, instead of CPI? And if they do that, how do they fund that? So did they sell assets to do
Yeah.
that and then they lose their NAV growth?
Mhm.
So there's a lot of intricacies around Greencoat UK. I'm happy to hold them for the next 4 or 5 years. But I think in the renewable space, the more and more I look into it, pure play renewables are quite hard. I actually think I'm leaning more into companies that are hybrid.
Yeah, but the sentiment has also
Of
shifted a
course,
lot, right? Look at what Trump is doing. Which
this is
European
this is in the
company?
UK. This is in the UK.
Yeah, no, yeah, I know, but there was a European company, I think, this week that is really in trouble because of the Trump policy of around wind in America because they had projects
Yeah,
lined up there,
yeah,
right? And you see this now, this wave through the Western world, effectively, that people are much more. Governments also start to become much more conservative with the investments, right? I think even this week the new climate goal in the European Union has been negotiated, and it's weaker than it used to be. Yeah, so I think sentiment is shifting a little bit because there are different people in power now, and I think it becomes even harder because a lot of these uh, say companies always dependent also a lot on government support,
exactly.
yeah, for the
Which is
investments and everything, yeah. And if that's falling away, it's not easy. It's not easy. That's why I'm more an Iberdrola when I think about new energy.
exactly
Yeah,
like I was just saying, the more I look into this market, the more kind of a hybrid company, Total Energies, for example, Schneider
yeah,
Electric is technically in this
yeah,
space. Those
yeah.
type of companies.
Picks and shovels as
Yeah,
well, right?
yeah,
Yeah,
and relying on and look, we call it out as a key risk that with Greencoat they rely so
yeah,
much on government income, and that can be. I mean, if
yeah,
the government can feed you, they can starve you, and you have to
yeah,
be aware of that. So it's a small position in my portfolio, but again,
yeah. For
I
me as well.
think the dividend safety is not as strong as I thought 2 or 3 years ago. So I think it's shifted a little bit on this. So I'm
Yeah,
not as bullish with Greencoat, but I am still bullish on renewables. I have to be clear.
yeah, yeah,
And a follow on to that question is Dividend Fin asked a really nice question about the oncoming energy and infrastructure boom in the US. There's forecasts showing more than 100 gigawatts of extra power demand by 2030. Some believe this could be a major driver in the stock market for many years to come. So there's a couple of questions around this. Do you think that growth is realistic, right? And to give you some context around that, the peak power in Germany at this moment in time is roughly around 75 to 80 gigawatts. So you're looking at adding the capacity of peak power in Germany in the US over the next 5 or 6
yeah.
years, right? So is that realistic? Is the first question. The second question: have we positioned our portfolios towards this long-term theme? And then the third question is: what do you see are the biggest long-term opportunities and risks in this space? So is it realistic? Yes and no. So look, a lot depends. Data centers are driving a lot of this growth, and it is the biggest bull case around that. And AI is obviously part of that because that needs more data centers and more power. You've got electric vehicles coming on the grid. So if all that plays out, it is realistic. But I did look up some articles, some research articles on these, and what was quite funny is over like 10, 15 analysts, none of them are even close to the same prediction. So there's a wide scale of where it is. So is it realistic? Yes. But I mean, you have to be careful when you're looking at this, and a lot can change over the next 5 or 10 years in this space.
And there's so much investment going into
E-
this,
Ex,
right?
ex,
But don't you ever think, like, for instance, what DeepSeek did? Yeah, that it was suddenly the model was so much cheaper. Imagine that I don't know. There's a clever nerd somewhere that builds an LLM that's like
but
20 times cheaper in energy
but you
consumption.
know that that's what they're going to be working on is because they know it's so power hungry, and look, the grids can't manage that demand at the moment. So it's going to be
Yeah,
quite difficult to manage that. So
I hope it won't be like such a city like in
yeah.
Singapore that then is totally built and nobody's living
Exactly.
there.
Yeah, yeah. But over time it will get more efficient and it'll get better and better, and you'll
Yeah.
be consuming less powers.
And we know that if AI won't use it, then it's the porn industry that will make use of the data centers. Yeah.
They won't go to waste. They won't go to waste. So, but
Yeah.
yes, look, I think if you look at projections and you look at what they're projecting in terms of data centers, the EV network,
Yeah.
and all this, it is realistic. But I just would not be 100% confident that it's going to reach those numbers. I'm not
Yeah.
100%.
If I learned one thing about project management, is like deadlines usually, you know, uh, get
Tell
extended.
me about it. Yeah, you know my job, so
Murphy's law is one
yes,
of the most important
yes,
ones,
yes.
right?
Hey, and you know, my mother's maiden name is Murphy, so like that law
Oh,
applies to me like you don't believe. Anyway, the second question was, have you positioned your portfolio towards these long-term teams? And I would say no. I
me
haven't
neither.
actively done that, but I am a big believer in renewables. So it is a space that and engineering companies I tend to
Yeah.
lean towards. But
But because positioning also suggests like that I would have sold some
ex-
positions and bought some
exactly,
others. So I don't do that. But of course, if I know that this is a strong theme and I'm analyzing a company and I could see this as a catalyst, yeah, that this, let's say, extra points, let's say, for
yeah,
that company.
yeah.
Yeah.
But like, there's a wide range of companies that benefit from this type of team, like even
True.
down as far as Microsoft. Because I spoke
Yeah.
there a few minutes ago about like they will not be able to like meet that demand. So that means
Yeah.
I'll get technical in a minute, but that means load balancing becomes really, really important. We have people doing those jobs now, but you can bet your bottom
Yeah.
dollar that AI is going to be a big driver in
Yeah.
controlling that. So yeah, there's loads of companies that can benefit from that. What's the biggest long term opportunities? I think AI is going to be big here. I just mentioned load balancing and getting all that really, because you have to upgrade. Look, you have to upgrade all these lines. I mean, electricity lines everywhere are probably 100 years old in Europe and also in the States. They all have to be upgraded. New lines have to be pulled in to support data transfer, load balancing it, and making sure people's lights stay on. So yeah, I think AI is a big one. Risks, regulation, and also this growth could be unrealistic. You buy into a utility now expecting it to benefit from this, and it simply may not. And capex heavy, we spoke about that earlier as well. So yeah, it's quite an interesting one. It's one that I'm super super interested in, but more from a European
Yeah.
perspective, I have to admit, than American. But nice question. And then the last question is from Mr. Marksy. What are your thoughts about the upcoming spin-off of the Magnum business from Unilever?
Um, I'm still on the fence on this one. I want to see more data about it. It's not entirely clear to me yet what it really means for my portfolio. Wasn't it like 1 on 5 or something like that when it came to
Yeah,
share deal? Um, you know, Magnum has been doing continuously shrinkflation. I expect also debt to be loaded in there, so it doesn't sound attractive enough to me. Yeah, on the top line, but I would need to go more into to the detail to understand what I really want to do with the
yeah,
shares.
yeah. I won't have that problem. I don't have Unilever, so I
Yeah,
haven't looked at
true.
it.
Uh, I didn't like the CEO of Magnum when I listened to his conference call. It was like Louis van Gaal talking, and gave me the chills on my no, the shivers.
Cool. Okay, that was the last question. I did say it was jam packed today, and it was an hour and a
Yeah,
half.
1.5 hour, buddy.
So, thank you to all our listeners, as usual, for sticking with this one for this long. We know an hour and a half is quite long, but if you are running, keep going. We're right behind you, sitting
Exactly.
in our chairs, nice and comfy in the warm. But yeah, keep going, and we will see you all next week.